Good morning and welcome to TOI Japan Market Radio. Today is March 7, 2026, and I'm coming to you from Tokyo with our daily briefing for global investors tracking Japan. Joining me as always is our portfolio manager focused on Japanese markets. Before we dive into the headlines, I should note that the Japanese market was closed today for a holiday, so we're looking at overnight futures action and the broader themes shaping sentiment heading into the next session.
Thanks for having me. Yes, the market holiday gives us a useful moment to step back and assess what's been a fairly turbulent week for Japan. We've seen significant pressure on equities, the Nikkei 225 and TOPIX posting their worst weekly performance in 11 months, and that's coinciding with rising trade tensions and some notable currency volatility. Overnight futures were down sharply, so the setup heading into the next trading day is certainly cautious.
Let's unpack that. The first major story we're tracking is the broader weekly context. Last week, the Nikkei 225 and TOPIX recorded their worst weekly losses in 11 months. That's a significant reversal after what had been a relatively stable run through much of 2025. What's your read on what drove this sharp sell-off?
It's a combination of factors, but the breadth of the decline is what stands out. When both the Nikkei and TOPIX fall in tandem like this, it signals systemic weakness rather than just a few sectors underperforming. We're likely seeing a confluence of macro headwinds, including concerns about Bank of Japan policy expectations, potential yen strength impacting exporters, and broader global growth anxieties. The fact that this is the worst week in nearly a year suggests that whatever support had been underpinning Japanese equities through 2025 has weakened materially.
And for investors who've been long Japanese equities, what does this mean in practical terms for positioning?
The immediate concern is whether this is a correction within a longer uptrend or the start of a more meaningful regime change. Technically, if we see key support levels break, there's a risk of further capitulation. On the FX side, risk-off sentiment typically supports yen strength as a safe haven currency, so we could see the yen appreciate if this equity weakness persists. That creates a feedback loop where yen strength further pressures exporters. Meanwhile, JGB yields would likely move lower as investors rotate into bonds in a flight to safety. So across the board, equities, FX, and yields, we're seeing risk-off dynamics starting to dominate.
Staying with the yen theme, let's turn to the trade story. Japan is actively seeking an exemption from U.S. tariffs, and this has been a major driver of USD, JPY volatility. The headline is that trade tensions between Japan and the U.S. are lifting the dollar-yen pair. Can you walk us through why this matters so much for Japan specifically?
Absolutely. Japan remains highly dependent on U.S. market access, particularly for its major export sectors like automobiles, semiconductors, and machinery. Any tariff that gets imposed without exemption directly hits profit margins and competitiveness for these companies. So diplomatically, securing an exemption is absolutely critical. On the currency side, trade tensions and tariff uncertainty typically weaken risk appetite toward the yen, which paradoxically supports USD, JPY strength. We've seen that play out in recent sessions. The challenge for Japanese policymakers is navigating rising U.S. protectionism while maintaining the bilateral relationship, which is strategically vital.
So if I'm an investor looking at this, what's the net impact on Japanese equities? Because a weaker yen is usually positive for exporters, but tariffs would hurt them. It seems like a push and pull.
Exactly. It's mixed. Exporters do benefit from yen weakness because it makes their products more competitive overseas and boosts repatriated earnings. But if tariffs are imposed, that advantage gets eroded or even negated. So the outcome really depends on whether Japan succeeds in securing exemptions. If they do, you get the best of both worlds, a favorable exchange rate without the tariff drag. If they don't, the tariff headwind could outweigh the FX benefit, and that would be negative for the Nikkei and TOPIX, especially for export-heavy names. On the JGB side, we'd expect yields to remain relatively stable or drift slightly lower on safe haven demand, though BOJ policy is still the dominant driver there.
And USD, JPY itself, where do you see that heading in the near term given this trade uncertainty?
I think it's likely to remain elevated, probably with a bias toward further dollar strength, at least until we get clarity on the tariff negotiations. Trade tensions and the risk-off tone are both supportive of the dollar. If the exemption talks stall or fail, we could see another leg higher in USD, JPY. Conversely, if Japan gets a favorable outcome, some of that tension unwinds and the yen could recover. So it's very much a binary outcome trade right now.
Shifting back to equities, let's talk about what happened overnight. Nikkei 225 futures fell 1,710 points during the night session, closing at 54,020. That's a sharp single-session decline. What's your take on what drove that move, and what does it signal for the next trading session?
It's a meaningful drop, and it suggests that investor sentiment remains firmly in risk-off mode. Futures pricing often leads the spot market, so this decline is a warning sign that the spot Nikkei could open lower when trading resumes. The drivers are likely a mix of the trade tension headlines we just discussed, the broader weekly sell-off that we talked about earlier, and possibly some global risk-off flows. When you see a move of that magnitude in the night session, it usually reflects either a significant headline or broad institutional selling. Either way, it's a bearish signal.
And if that selling pressure continues, what are the knock-on effects across the rest of the Japanese market complex?
Well, equities would obviously be under pressure, particularly if foreign funds and institutional investors remain net sellers. The Nikkei and TOPIX could both see further downside, and we'd need to watch for technical support levels. On the yen side, this kind of equity weakness typically supports the yen as a safe haven, so we might see some yen strength, which would mean USD, JPY could weaken from current levels. That said, if the selling is driven by capital flight rather than risk-off, you could see mixed signals. For JGBs, a flight to safety would push yields lower, especially for longer-dated maturities. Investors would be rotating out of equities and into bonds, and that's a classic risk-off setup. So we'd be looking for JGB yields to compress if this equity weakness persists.
It sounds like the key thing to monitor is whether this is a temporary correction or something more structural. What indicators are you watching to differentiate between the two?
I'm watching a few things closely. First, any communication from the Bank of Japan, whether they signal any shift in policy stance or express concern about financial conditions. Second, upcoming economic data, particularly any signs of weakness in domestic demand or corporate earnings. Third, the technical levels on the Nikkei itself. If we break below key support, that increases the risk of a more extended downturn. And finally, the outcome of these U.S. tariff negotiations, because that will determine whether the external environment improves or deteriorates further. If we get positive news on any of those fronts, this could just be a correction. But if the news flow remains negative, we could be looking at a more sustained period of weakness.
Let's bring this all together for our listeners. We've got a market that was closed today, but the signals from last week's performance and overnight futures are clearly bearish. Trade tensions are adding uncertainty, and the yen is caught in the middle of conflicting forces. What's the main takeaway for global investors with Japan exposure right now?
The main takeaway is that we're in a period of heightened uncertainty, and that uncertainty is manifesting across equities, FX, and rates. For investors, this is a time to be cautious and selective. If you're overweight Japanese equities, you might want to reassess your exposure, especially to export-heavy sectors that are vulnerable to both tariff risk and yen volatility. On the other hand, if you're looking for opportunities, weakness in high-quality names could present entry points, but I'd want to see stabilization first. On the FX side, USD, JPY is likely to remain volatile, so any hedging strategies should account for that. And for fixed income investors, JGBs could offer some safe haven value if the risk-off tone continues. The key is to stay flexible and watch the data closely.
Great summary. As always, no specific investment recommendations here, but we hope this gives you a clearer picture of the dynamics at play in Japan right now. If you're a global investor tracking Japan or managing exposure to Japanese assets, we'd love for you to subscribe and join us for the next briefing. Thanks for listening to TOI Japan Market Radio, and we'll see you next time.
Thanks, everyone.